Hey everybody, in this video we are going to cover chapter 15 in managerial accounting. We are going to talk about job order costing. The first thing that we need to talk about though is a cost accounting system. This is super important to have in place at a manufacturing company to make sure that we are assigning all of the costs that are relative to creating a product to that product. This really helps us to determine how much it costs to make it, and then we know how much to charge for that. So this is really important for internal accounting, which is what managerial accounting is, so that the managers can assess how much does it cost to make this product, how much profit do we want to make. Normally they have a certain percentage that is their target, and that helps us figure out how much to charge for that item. So when it comes to different types of costing, we have process costing. This is what we'll cover in the next chapter. This is where we have mass production. So like Coca-Cola, they're probably making tens of thousands of bottles of that delicious sugary drink every single day. Those are all exactly the same. Of course, they have a variety of drinks, but they're probably making 10,000 Coca-Cola and then 10,000 Sprite or whatever it may be. That is mass production. So that one we're going to focus on in the next chapter, but in this chapter, we're going to focus on job costing. This is where we have like a custom order or something really specific to that customer that is going to cost different amounts than what all the other customers are purchasing. So really important for us to track so that we know how much to charge that specific customer, because they're all going to have to pay different amounts. And we know exactly how much profit that we're going to be making off of that. So we're going to really focus on that today. The first one I'm going to show you is, I wonder if any of you know what kind of table this is. This would be a very custom made table. You would not see this table in a regular furniture store. You wouldn't see this in Rooms to Go. This is a Dungeons and Dragons table. I have never played that. I'm a big board game enthusiast, but never played Dungeons and Dragons. But you can tell this table would have been something that somebody really specifically ordered. It has the lamps on it. It has outlets. It has cup holders. It's got the little Dungeons and Dragons logo on it, the sword going down the side. I don't know what the thing in the middle is. I'm sure some of you are probably yelling at me right now, like, I know exactly what that is, or you're pronouncing things incorrectly or whatever. But this would have been a really custom made table. So it's not like they just say, all of our tables cost $1,000 to make them. No, this would have been really specific, and they would have need to track all of the specific costs. How much did it cost us to add these little fold down cup holders? How much did it cost us to put the electrical outlets in it? How much did those lamps cost us? How much did those designs that we put on there to make it really specific cost us? And this is clearly solid wood, which is expensive in itself. So they're going to have to track this really specifically to make sure that they charge the customer the appropriate amount to make sure that they make some money off of it. So again, this is custom for special orders. So when all of the activities that go into making that custom order is called a job. So job order costing. If there's going to be several of that custom order, that would be called a job lot. So let's say instead of ordering one Dungeons and Dragons table, we have a company that's opening a whole franchise, a whole building, maybe on a main road that's going to pull in a lot of the people that really love playing this game. And they want to start out with 4 of those custom made tables. If that's the case, it's more than one of the same item, but it's all custom. We're going to call that a job lot. So they're going to track those costs, not just for one table, but times 4. So what our focus is in the book on this chapter is going to be for vehicles. So I think they're putting alarm systems in vehicles in this Road Warriors company. And just like we've seen before, the main things that are going to go into producing a product is going to be our materials. Some of those are going to be direct materials. So when it comes to wiring a car for an alarm system, this is probably not the best topic for me to speak on because I don't know a lot about this. But I'm assuming, so obviously they're going to have some wires. They're maybe going to have some kind of sound effects. They're going to have some kind of detection if somebody were to try to break into the car, the alarm system's going to go off. Those would be direct materials. So those get charged directly to work in process as soon as the company starts working on a specific car. Then we have our indirect materials. So maybe this is some nuts and bolts for putting in this system. Those are going to make a little pit stop in our factory overhead cost. Then we have all of our other overhead costs like depreciation expense, insurance on our equipment, rent for the building that we would be putting in these alarm systems. Then we're also going to have our labor. Some of that will be indirect. That's going to be like the supervisors that are watching these things get done, watching these jobs be produced. And then there's direct labor, which again is hands-on, the people who are actually putting in the alarm systems into these vehicles. So as you can see, in work in process inventory, they have 5 different jobs happening. They're all very different vehicles. They're surely going to need different amounts of work that goes into them. And they have labeled each one with a job number. So we have job B15, job B16, all the way through job B19. So every time that we put any work into one of these jobs, we want to assign it specifically to that job so we know how much it costs for job B15 versus how much it costs for job B18. As you can see, some of these are completed and they've moved to finished goods. And then 2 of those were actually delivered to the customer, and those move from the balance sheet to the income statement to cost of goods sold. Looks like job B17 is ready, but maybe they're not delivering it until next month. And then they're still working on job B18 and 19. So this is just a look at how the production is going for the cost for this job order costing system. So how does it work where they get from the raw goods to where they're actually in work in process? There's going to be a materials requisition, and this is whether it is indirect or direct materials. The department for production is going to say, we need 10 more wires to create the system. So they are going to fill out a materials requisition, might look something like this, probably going to be online, not a physical copy. And they send that to the manager over the raw goods. And they say, look, we are creating job B15. We need this material. This is the materials number. This is the date. This is alarm system wiring. We only need 1. And then the production manager signs off on it. Then when they provide it, the materials manager signs it saying we're providing this, and then the production manager signs saying we received it. Looks like they had a fast turnaround. They did it all on the same day. So this right here is where it moved from our raw materials to our work in process. It's all inventory. You know, if you were reading the financial statements as an external user, you would just see it as inventory either way, whether it's just sitting there on a shelf waiting to be put together, it's in the process of being put together, or if it is finished goods, it's ready to sell. Either way, if you're an external reader, you would see it all in inventory. But in managerial, for the internal purposes, for the managers, they'll see which phase of the process each of these are in. They can make a journal entry every time they have one of these requisitions. They could make them at the end of each day for all the requisitions. They could make it at the end of a week if they wanted to for all of them. It's up to each company and what their process is. So let's look at how the journal entries would work. So whenever the materials were purchased by the materials manager, we would increase raw materials inventory. So for this one, they purchased $2,750 worth of materials. And then, of course, we would credit accounts payable or possibly cash if they pay for it up front. Then once that materials requisition is fulfilled, it would move out of, so since inventory is an asset, it would be a normal debit balance. It would be credited to move out of raw materials inventory, and it's moved into work in process inventory. It's not just sitting on the shelf as an individual good. Now it is in the process of being turned into a product that we're going to sell, or in this case, the job, which was the alarm wiring. Again, both of these are inventory accounts, wouldn't look any different to the external readers, but internally, we see that they are in different stages of the process. Then, of course, we have our labor. So you're going to have some type of time ticket. If you have a job, you know that you typically would probably clock in on the computer. And if you were working on jobs like they are at this company, at Road Warriors, they would enter what job they're working on. So T. Zeller, he's got his employee number. He would enter in, I'm working on job B15, so that it's very clear that his time was put into this one. He worked from 9 to 12 on it. It was 3 hours. He gets $20 an hour. So $60 of direct labor was put towards this job from T. Zeller. Maybe he didn't go home after that. Maybe he then clocked out of job B15, clocked in to work on job B18 so that they could track that time separately. So that could be the case as well. So there's our time tickets. So remember that even labor, when we're talking about producing items, if it is direct labor, that is actually added to work in process inventory. Because if it wasn't for T. Zeller here, we would not have this alarm system put into the vehicle. We don't have machines that are doing it. Maybe we have some machines to help, but we needed T. Zeller to work on this. So his time is actually part of inventory. So we debit work in process inventory for that labor, and we credit factory wages payable until they pay him his cash or paycheck. All right. The trickiest thing is always overhead costs, because it's really hard to know exactly how much all of the indirect costs are going to be. And sometimes we are not going to get those costs, the actuals, until the end of an accounting period, maybe the end of the year. We're going to look back and add them all up. But we want to make sure we're charging, because that can be a significant amount. So we want to make sure we're charging that to these jobs and not forgetting that, oh yeah, this took indirect labor, this took indirect materials, this took electricity. There was depreciation on the building that we used for putting these jobs together. So we need to go ahead and assign the overhead, the indirect cost, to the jobs, to the products, even though we're not exactly sure how much it's going to cost or how much it costs for each one of these. And as we get farther into this course, we're going to see how we can more accurately estimate how much the overhead's going to be, but this is going to be our initial process. I would say overhead cost is one of the most important things that we learn in this course, and you will see it pop up over and over again. So it's really important to understand how to calculate it, and there'll be different calculations, but in this one, it's pretty simple. So first we come up with a predetermined rate, and I'm going to show you the formulas for each of these. Then we apply that rate, that estimated rate. This is predetermined. We don't know exactly how much overhead costs are going to be. We apply that predetermined rate to the products based on some type of activity that we have deemed as the way we apply it. I'll show you all that. Then as the actual indirect costs come in, we record those and then we compare them. So this is how we figure out predetermined rate. We take the estimated overhead costs. This is probably for the whole year. This might be, here in our example, it's $200,000. So again, that's going to include the rent for the factory. That's going to include the indirect labor, indirect materials. That's going to be insurance. It's going to be maintenance on our machines. All kinds of things are going to go into this. So it can be a really, really big number. So we don't want to ignore that $200,000 of costs need to be allocated to these different products. That way we charge the customers enough and we actually understand how much profit we made. So we estimate. How do we estimate? They're going to give us these numbers in this class, but in reality, they would look back at past numbers. They would look forward at what jobs we have coming and make the best estimate that they can, hoping to get it as accurate as possible. Then we divide it by some type of activity base. Usually you'll see it as direct labor hours. You might see it as machine hours or even direct material cost. but most common is the direct labor hours. Just make sure you pay attention when you see word problems, exactly what they're asking for here, what the activity base is determined to be. So this is also an estimate. We are estimating from looking at the past, looking at the future orders, how much are we going to spend on direct labor costs? So these are both an estimate. This gives us a predetermined rate of 160%. So then based on how many direct labor hours actually go into making a product, we'll multiply that times 160% or 1.6, and that's how much overhead cost we will apply to that specific production of that good. So for this example here, they're saying that actual direct labor hours cost us $4,200. We multiply that times 160% or 1.6. That tells us if we have $4,200 of direct labor cost, we are going to apply $6,720 of factory overhead to that. It's an estimate. We're hoping we get it close. It is an estimate, but that is $6,720 that we are going to apply. So this is what the entry would look like. We are going to debit work in process inventory because we're increasing how much the inventory is, because all of these costs that we're estimating have to happen for us to be able to produce our inventory, whether that's mass production or if that is job order costing. And then we credit factory overhead. This is where all those costs are making a little pit stop in factory overhead, but this is a credit to factory overhead. So this is an estimate. When we actually see the real costs coming in, we'll see them debited. So I'll show you that in a minute. Okay, so for job B15, we are finished with it. We now take this cost, this job cost sheet, and we write down what all of the costs were that went into it to determine how much it cost us to make or to complete this job. So in this area here, this first category, direct materials, there were 4 different times they did a job or materials requisition. Here's how much each one cost. So it was a total of $600 of direct materials. We looked at all the time tickets. Our direct labor totaled $1,000. So each employee would be sure to clock in and put which job they're working on. So for job B15, it totaled $1,000. For this one, remember we based our factory overhead estimate off of 160% of whatever our direct labor costs were. So we took 1.6 times 1,000, the actual direct labor cost. We got 1,600 of direct labor cost. It's an estimate, but that's what we deem to be the best way to apply it. We add together materials, labor, and overhead to get $3,200 was the total cost for job B15. How much should Road Warriors charge this customer for this B15 job? More than $3,200. It was $3,200 was their total cost. Hopefully they can charge them $6,000 or something, but anything over $3,200 would be profit. But if we charge anything less than that, then we would be giving this away. We would have a loss for this. So this is just a reminder of the process that we just did. We figured out the predetermined rate. We took the estimated overhead costs divided by an estimated activity base, which we use direct labor hours for. Then second, we applied that rate by taking the overhead rate from the formula before times the actual number of direct labor hours or whatever the activity base might be. Then at the end, we want to look at the actual costs that came in as they've been recorded for estimated or for actual overhead and compare it to the estimated amount. So that's what we're going to do next. So these were the actual things that were recorded in overhead. We had indirect materials, indirect labor, and all the other things. So for raw materials, we had $550. It was debited to factory overhead. So actual costs are debited to factory overhead. Estimated costs, the applied amounts, are credited to factory overhead. It left raw materials inventory with a credit, moved into this little pit stop before it goes into work in process, so we can put it in factory overhead to make sure we keep track of all of our indirect expenses. We had indirect labor of $1,100, and that is going to be debited also to factory overhead, and we credit factory wages payable. And then it will later move to work in process inventory. Then we have all the other things: depreciation, rent payable, utilities payable, prepaid insurance. Those all stop in factory overhead before they go to work in process, and that was $5,270. Do you remember how much our estimated overhead was? We were applying, remember, $6,720. So we credited factory overhead based on direct labor costs, all estimated amounts there. We applied $6,720. That's what got moved into work in process. It would have moved to finished goods. It would ultimately move to cost of goods sold. But now we get the actual numbers and we're like, oh, it's actually $6,920. So we have a $200 difference from what we thought and what the actual costs were. It actually cost us $200 more for all of these indirect costs. So our actuals were $6,920. Our applied, our estimated, was $6,720. Our actuals were $200 more. If we will consider it underapplied. We did not apply enough. We did not estimate enough. If our actuals are more than our applied amount, so then we underapplied it. We didn't charge enough to cost of goods sold. We did not charge enough to the customer, perhaps. Maybe we just showed too much profit. But oh man, it was actually $200 more for this period for overhead than what we expected. It's overapplied if we actually estimated too much. We applied too much, and then the actuals come in and they're like, oh, it's actually less. That's the place you want to be, is figuring out that, oh, we actually did not apply enough. So for road warriors, they underapplied. Their actuals were more than their estimate. They underapplied by $200, just like we had calculated the 6,920 minus the 6,720. They did not apply enough. So we are then going to, and this is always going to be the entry, if it's underapplied, we will debit cost of goods sold, because at this point we're assuming it's left inventory and we have sold these items and we didn't put enough in cost of goods sold. Remember, cost of goods sold is like an expense account. It is always debited. Factory overhead would then be credited, which would make both sides of the equation, or the T account, 6,920. Since the credits were not enough, we're now increasing it by 200, and now they zero out, which is what we have to do every time. If it would have been overapplied, we would have done the opposite. We would have debited factory overhead and credited cost of goods sold, saying, hey, we actually put too much in cost of goods sold. That's awesome. We made more profit than we even expected. So this is just a reminder of how each of these work. We start with, when it comes to the materials, we start with our raw materials. That gets moved into work in process along with direct labor and all of the overhead that we estimated. As we complete those items, they go to finished goods inventory. This whole time it is in inventory, it's on the balance sheet. Then once we actually sell it, it moves to the income statement and cost of goods sold. So just to recap, I'll finish up here of what we did. We had raw materials that were used up. Some were direct and they went straight to work in process. Others were indirect that made a pit stop in factory overhead. The other accounts, the depreciation, insurance, all those went into factory overhead before they moved to work in process. And then we had our indirect labor that made a pit stop in factory overhead. And then we have our direct labor that went straight to work in process. All of that was used in work in process. As we finished some of those, we completed some of them, they moved to finished goods sold. The ones that we actually delivered to the customers went to cost of goods sold. The remaining was for that one job that we completed, but we had not delivered yet. So we have these two jobs that were delivered. Those are now in cost of goods sold for all of their expenses. We have the one sitting in finished goods sold, we just need to deliver. And then we have the two that we're still working on that will probably finish in the next month. All right, reach out if you have any questions. Hopefully that all made sense. And I hope that you'll have a wonderful day.